Hey traders, welcome to this week's FX commodity and crypto game plan. I'm Matt from Seneca Analytics, and let's get started with the news that matters. So obviously China is still front and center for us as we watch the contagion flow out of China from their property collapse, their property market collapse. That's still going to take time to play out. As you know, Lehman only collapsed and fully went bankrupt a couple of months, up to 8 months after we started to see weakness in the housing market in the US. So this isn't something that's going to happen overnight. We saw a crackdown in those fundamentals over the last few months in China, and that's going to continue to flow into the Chinese economy and beyond that into the rest of Asia and beyond that into the global economy, as we believe and still believe that deflationary shock is going to be coming out of China. So firstly, we saw in South Korea's economic recovery's momentum has weakened due to the slowdown in manufacturing sector amid a global supply chain shortage and energy crisis. So we continue to see those factors that are weakening those Asian economies, the global supply chain shortage, the energy crisis, and a slowdown in economic conditions as a result of COVID. So that still remains front and center for us in South Korea, as well as in Hong Kong, where Hong Kong's fiscal reserves are under threat as a result of public expenditure. So government expenditure was approved for 39 billion in government projects over in Hong Kong. And as you know, government projects are only really greenlit and take front and center when economic slowdown comes into play. So the government tries to support the economy with government expenditure, but with government debt at such high levels, that expenditure has a very low effect on GDP down the line. So we're just seeing a kind of last-ditch effort by governments to prop up economic conditions and the economic recovery post-COVID. And as you know, that is weakening across the board, and it's just going to continue to weaken. And what we're seeing in China is a meltdown in the bond market, with Bloomberg reporting that the China bond market meltdown bringing a world of hidden bills to light. And what we saw there was that Evergrande and Kaiser have billions of dollars in hidden debt that will take priority over repaying the US dollar bonds. So this story is far from over. And we started to see that in the China bond market, where the China high yield index has been kind of up over the last, or down, or yields have been rising over the last 10 of 11 trading days. We saw kind of a range from around about 7 to 10 as the norm in China, and we're now sitting at around about 22% yields of China junk bonds. So we're seeing a blowout in the junk bond index, and that'll sure to spread over into the more low risk bonds that are in China. So definitely something to be watching for as the China contagion flows through the system. So, another issue we have is China's stagflation, which is going to be a big concern, where we see inflation continue to rise despite a slowdown in economic conditions. So China's economy has slowed sharply in recent months as efforts to rein in the property market ripple through industries from construction to commodities. So we're seeing that ripple out just from the property breakdown. We're seeing construction materials break down. We see commodities breaking down. We see manufacturing slowing down. So that contagion continues to spread, even though inflation in China is forecast to be rising. We also have, again, like we said, the energy shortages, which is forcing factories to slow their output, and stringent measures. We've seen coronavirus resurging in China, and we're seeing big stringent measures to stop the spread of the virus throughout China, which is kind of a very draconian measures that China continues to follow, where China was warning its citizens to stock up on food as they were going to go into another lockdown. So again, new downward pressures on the Chinese economy, plus China's factory and consumer prices forecast to accelerate in October. So those numbers coming out this week, and we're seeing inflation continue to rise in China despite an economic slowdown, which leads to stagflation, which is a very, very poor outcome post-corona for China, and which is going to obviously have its effects in the global economy moving forward. And one sign of hope that we have is that China's exports are beating expectations, where we saw a strong trade performance is providing support for the Chinese economy that slowed sharply in recent months due to weak domestic demand caused by real estate downturn, electricity shortages that have slowed industrial output, and weak consumer spending worsened by sporadic outbreaks of the coronavirus. That was reported by Bloomberg. So there was a little bit of sign of hope coming out of the export figures, and that China's trade growth has been well above pre-pandemic levels this year. So it's yet to see if that's just as a result of supply shortage and the supply chain breakdown across the globe. We believe that is temporary. As you can see, economic slowdown in China is not going to be a good indication of future growth in the global economy moving forward. So we believe this is all just supply shortages that's being kind of solved and sorted out, which we'll see in the dry bulk index later on. And once these unwind, we'll go back into that deflationary environment and a deflationary shock, especially because the Fed has now started to announce that it should be starting its taper later in the month of November, from pushing from a reduction of 15 billion each month from the current 120 billion a month that the Fed is buying. So it's a very small reduction, but it's starting to show that the Fed is taking off the gas on its massive stimulus that it's been pushing into the economy, the massive amount of help it's been providing markets and the economy. That's starting to come off the gas, as we believe that a US economy is starting to slow, and obviously the Chinese economy is starting to slow. So this could be one of the ignition points for that turnaround in the global economy, because the Fed is kind of stuck in an unwind where inflation's rising in the US, but the economy is not really growing as much as they would want it to, or as they believe it is. We see economic numbers in terms of employment coming out really strong on Friday in terms of expectations, but we're still seeing a good 6 million jobs that haven't come back following the breakdown in COVID. So there's still massive issues in the US employment figures under the surface. But on top of the surface, the Fed sees everything's good and it's willing to start tapering. So we believe that's going to start to crack the economy wide open, and not in a good way moving forward. We also have some kind of indication that all is not well in the global, or in the US economy at least, as Buffett continues to reach record levels for its cash pile. So if there were any good investments out there, people like Warren Buffett, these prudent value investors, would be putting that money to work. But as you can see with the sprawling conglomerate's cash pile hitting records of 149 billion, and stock buybacks kind of on the increase for Warren Buffett, we can see that that is not really the case, because that money doesn't have a home anywhere else in terms of strong potential future returns in their investments. So Berkshire Hathaway and Warren Buffett stockpiling cash to wait for better days down the line. So it's just an indication that things may be not as good as are being presented in the US economy. And finally, going back to our Baltic Dry Index, as it continues to free fall, we said it's a potential sign that the global economy is starting to slow down. At the very least, those supply chain issues are starting to unwind, and we believe that's just the first step in seeing a deflationary shock, or going back to deflationary environment in the global economy. And the Baltic Dry Index, as you can see, just continues its free fall, now down 52% from October highs in early October. Just an indication that things aren't as good as the news is stating. So we'll be watching that pretty closely, and watching for that contagion to continue to flow into China, into Asia, and eventually into the rest of the global economy. Heading into the economic calendar this week, kind of light in terms of economic news, especially in comparison to last week. We have German trade balance on Tuesday, which may be a sign as to what's happening in China. Once again, just subtle signs of what's happening in China, because Germany, one of the big trade partners for China, may be showing that things are slowing down in that region. We have US PPI on Tuesday, maybe a sign of potential inflation or turnaround in that inflation figure. We'll have to wait and see what gets represented there. Then Wednesday, we have CPI figures from China, Germany, and the US, which could just show, again, maybe a slowdown in those inflation figures, and maybe a step towards that transitory inflation that the Fed has been alluding to. And what we kind of believe is the case as well, as we believe we're heading more towards a future of disinflation and deflation once that economic slowdown begins to hit, and kind of fueled by the Fed's tapering and the slowdown in Fed support of the US economy. We have Australian employment on Thursday, another potential sign of economic slowdown in Asia, and UK GDP on Thursday. And then Friday, Michigan consumer sentiment over in the US, which could be an indication of a leading indicator of a global or a US slowdown in their economy. So let's head over to some charts of interest to watch what's happening around the economy in terms of technicals. So as always, starting with the dollar, there's a little bit of a concern that we may see some dollar weakness, but it looks like it's going to be more contained towards euro strength. Obviously, the DXY very heavily weighted towards the euro. The structure itself does allude towards that euro strength, the potential move in the DXY down towards kind of 92. But again, like I keep saying, this is not confirmed. When we look at the structure, it's very possible that this is what we would call a wave failure to the downside. We never made it to new lows on this wave failure, and this may be just the start of an impulse to the upside rather than the move starting from these lows here. So we're still kind of on the fence in terms of that dollar move. I lean more towards being a dollar bull, because when we move outside of the euro, which has that same structure as the DXY, obviously with a potential move up to 119, we move into something like the pound. The pound is already breaking down out of its corrective structure. We've had an impulse off the highs, which would be from 142 odd, higher 142s, down to this region here at 136, and we went into this bigger corrective structure, and then we're breaking down out of there following that announcement from the BOE that they would not be hiking rates, putting a lot of people on the back foot. And that's just showing the kind of structure leaning towards more dollar weak or more dollar strength against the pound. And when we zoom out to the weekly chart, as you can see, we're looking at a structure that moves towards kind of March lows fairly soon or fairly quickly over the next kind of 2 years, maybe even less than that, as we start to accelerate to the downside out of this bigger ABC corrective structure. So it looks to me like the pound is breaking down, and with that, some other of the US dollar pairs, some like the Aussie dollar, US dollar, as we mentioned last week, we said expect a move up towards this kind of 75.50 region, and then a fall from there as this bigger corrective structure plays out. As you can see, we've got this nice A wave up, nice choppy B wave down, nice complex C wave up, and now we're breaking down to the downside from there. We can see on the lower time frames, very impulsive move out of this kind of rising wedge on the lower time frames, which indicates to me dollar strength once again. So Aussie dollar looking pretty weak, New Zealand dollar, US dollar, another one that looks pretty weak, another very clean corrective structure, a nice choppy A wave up, all the complexity of a B wave that we look for, and then a nice looking C wave. And now we're breaking down from the top of that C wave, which kind of lends itself towards more dollar strength moving forward. So New Zealand dollar, US dollar looking weak, US dollar CAD breaking higher out of this lower time frame structure. We've got this big ABC corrective structure. We might see some short-term US dollar weakness with the CAD as this kind of corrective structure completes itself on the lower time frames. Then on the higher time frames, we're breaking up out of a corrective structure, especially on the weekly. We look at this corrective structure, beautiful A wave, beautiful B wave, beautiful C wave, which means we're now pushing up towards new highs on the US dollar CAD, or a high probability of new highs on the US dollar CAD once these lower time frames kind of sort themselves out, which kind of lends itself towards a very unusual expanding triangle, but definitely in line with the rules we follow for an expanding triangle, and with the uncertainty in the global economy where you expect global expanding triangles to be on the charts. And now we should be breaking up out of that, showing that US dollar strength against the CAD. So you can see all of these commodity currencies definitely looking weak, and we'll get into commodities later, which also potentially may be turning. US dollar Swiss is another one. Structurally speaking, going out to the dailies, we're looking for a turnaround here and a move back up towards kind of 95. Definitely highs last seen, I would say, in June, March, somewhere around there, the beginning of coronavirus, going back to those levels. We'll see a pullback after that, but structurally speaking, we're looking for a stronger US dollar against the Swiss. US dollar yen, kind of uncertain about the yen, so we're going to leave that there. Silver, Still believe we're going to get up into this 25, 26 region and then fall down from there in terms of that structure. That looks like it's key. We may have been breaking down last week. We took a kind of short-term trade, kind of lower risk trade where we entered the trade on the break of this little trend line here and moved to break even very, very soon after that. So it was a high risk trade. We moved our stop to break even just in case we were breaking down from this region. From the end of the week, it looks like we started to head higher. It doesn't change the fact that I believe we are going to turn. It just matters that the level is going to be different. So we're going to turn, I believe, from kind of 25 to 26 and then look to re-engage that short trade after taking break even on this one. So I remain bearish precious metals, but it looks like precious metals may be in for a little bit of a run over the next few days, maybe a week or two until we see that turn. Gold, same thing. Structurally speaking, I still believe downside is on the cards. We're just in a very messy section of this chart. So we might see this E wave turn into more of a expanding triangle than a contracting triangle, which means we'll see gold up to 1850 and then see a turnaround from there down towards that 1675 region. So watching for that as well. The precious metals, although they are rallying at the moment, I do believe they are going to break down eventually. Copper has been breaking down already, no resurgence there. So copper topping out around about 480, back down to 430 now in a pretty strict or pretty quick impulsive wave. We believe this should continue all the way down to 380, get one last bounce up to 4, and then drop from there pretty strongly as that global slowdown comes into play. And pretty similar scenario with platinum coming out of this big ABC corrective structure, topping out around about 1080, maybe up to 1100, but failing to kind of match what silver and gold did. This just shows we're potentially breaking down already in the platinum chart. Some other charts of interest to me, the pound looking pretty weak across the board. Pound Swiss breaking down pretty strongly last week, and a weekly structure that indicates much more weakness to come down the line to probably make new lows again at 110, and pound yen breaking down pretty strongly coming out of a very clean corrective structure on the weekly chart. Keeping in mind weekly chart, weekly price structures definitely more reliable than lower time frame structures. So this is a fairly high probability that we are breaking down from here. And when you go into the lower time frames like the daily, you can just see how we've accelerated pretty much in a straight line from the highs at 158 all the way down to close of 153 on Friday. And that should continue to run, as you can see, with our trade kind of profit targets down towards the lows at the very least, probably beyond that over the next few months and years ahead. But definitely seeing the pound breaking down. Another chart of interest, Aussie dollar yen and all the yen pairs. If we zoom out to the weeklies, if you guys remember what we stated in our kind of beginning of the year, we did our video giving us a forecast for what we believe is going to occur across the markets over 2021. We said watch for the Aussie dollar or yen to get into this kind of 86 to 89 region and then start to pull back really strongly from there. And we stated kind of a couple of weeks ago that we believe the yen is going to regain its safe haven status. And as you can see, we've got this massive weekly engulfing candle to close things out last week. Maybe just a sign that that Fed taper is starting to put pressure on the global economy, and we're going to start to see the Aussie dollar yen break lower. So we'll be watching that pretty closely this week. Same with New Zealand dollar yen, another one breaking lower. Just entered a trade at the end of last week, showing that coming out of a little bit of a corrective structure. All these trades are based on the higher time frame structures where we're seeing that same impulse corrective structure, which could see a pretty strong move in the yen strength across the board. Same with the CAD yen, another very, very clean structure, another weekly engulfing candle showing an indication that we may be heading lower there. And then the Swiss franc against the yen, kind of holding up, but showing an interesting candle with this high test in a region where we expect a downturn. So the Swiss is holding up pretty strongly, but across the risk assets like the Aussie, New Zealand dollar, the CAD, those are showing that the yen is definitely maybe on the start of a resurgence into its risk-off safe haven status. We'll be watching oil this week. Oil looks to be in correction here. Very possible that we've seen a turn in oil, but we'll be watching to make sure that what we are seeing and what we believe we are seeing is a bit more of a corrective structure before we see another leg higher in oil. But it doesn't mean we haven't seen the top in oil. We've definitely done enough to turn back down in oil on the higher time frames, but we'll be watching to see if this is just a temporary pullback. We can re-engage our trade. We took some profits on this trade, and I'll be waiting to see if we can go back into the long or look to engage the short, depending what the charts are showing. We'll be keeping an eye on that. Some other things to be watching, obviously, emerging market stock exchanges across the board. EEM had another kind of week last week, going into a little bit of a flag now on the dailies for another potential leg lower, and a structure that indicates further weakness ahead, definitely on the cards for EEM. We see the same thing in Hong Kong, which is definitely breaking down out of this big expanding triangle, and a higher time frame structure that shows the same thing, a move down towards kind of 1367 on the cards, which is still another kind of 40% lower from where we are now. So a big move down in Hong Kong looks to be underway. Thailand seems to be holding up. The Kospi looks to be breaking down. A little bit of a break of that trend line, a little bit of a retest, and some bearish engulfing candle to close out the week. And if we go to the weekly, you can just see how we're looking at these candles that struggle to get up. You're just seeing a sell-off every time it tries to rally, that gets sold off. So we're watching for a slowdown in the Kospi, and another one that looks like it's going to move down, probably another 40-50% down towards 1400 on the Kospi. So we're seeing these emerging market stock exchanges breaking down, emerging market stocks break down, and we're just watching those currencies to follow suit this week. And then finally, moving on to crypto, we're kind of on the patience side of crypto at the moment. When we zoom in, it looks to me like we're just forming a little bit of a corrective structure in here. See a nice chop up to the old highs at 6780, 67,000, somewhere around there, and then one more pullback, and that should indicate another leg higher is on the cards as this consolidation kind of unwinds. That's what we're seeing at the moment. But it's also possible this move off the highs was the start of a bigger move down, and the corrective portion of that is actually only developing here. So kind of on the sidelines in the crypto world, waiting for more concrete proof of direction, and the same with Ethereum. We lean more towards downside on the cards moving forward, but kind of temporary downside at the moment. It looks like we'll just get a move to match that, but again, nothing certain. So just patiently waiting. We've got our core crypto position that we hold on to regardless, kind of the hodling position over a 10-year period. We try to trade in and around that, and right now we don't see much in terms of trading in and around that right now. So that's about it for this week. And one last chart, again, we'll be watching. This is the copper gold chart on the weeklies. That's just an indication of inflation versus deflation. When copper is rallying above gold or higher than gold, we see the copper gold ratio go up, and just shows economic conditions which point towards more economic growth versus risk off. So people are buying more copper than they are gold because they believe economic development is on the up. We said watch for this to top out in this region between kind of 25 to 35. It looks like we continue to break down out of that. If we go to the dailies, you can see how the copper gold chart is breaking down to the downside, being down. Even if you look at the weeklies, big weekly candles to the downside over the last 3 weeks, which indicates to me a turn in that copper gold ratio. And if the copper gold ratio starts to turn, that deflationary kind of thesis that we have is starting to play out, and we can watch that unfold. So just be very cautious of that inflation mentality that's on the cards, and we might see that start to unwind this week, as we said earlier. So cool, guys, that's it for this week. One last chart, the commodity index, as we said, watch for this to top out somewhere between 240 and 260. So far the rally continues pretty strongly, but oil starting to kind of slow down. We might start to see that slow down, but regardless of that, if we zoom out to the weeklies, we do believe that deflationary move is on the cards. As we said last week, that deflationary trade is lining up probably across the emerging market world. In 2011, it was the European debt crisis. So again, we saw the QE lead to inflation expectations rising, but then we saw a debt crisis in Europe lend itself to a collapse in commodity prices for the 10 years following that. Then we had COVID, big rally in COVID, and we believe they're going to see the same thing, a deflationary trade somewhere in this region, probably led by a emerging market debt crisis rather than Europe, and that's going to see a big slowdown in commodities moving forward. And I think we're already seeing that in China with the collapse in the housing market. It's cool, guys. Have a great week. Members, we'll see you in the members area. If you'd like to join us in there, we'll put a link below to give you some really good trade ideas and deep in-depth analysis of our charts every day, and a daily strategy session to look for the trades that we're looking for every day. So that's definitely something you should be looking for if you are more interested in getting into trading and the daily trades. Our course is on there as well. It's a 7-part course teaching you how to read the charts in the most efficient and most accurate way that we know about, or that we know and we've experienced over the last 10 years of researching technical analysis. If you're not that interested in the trading side, but you still want to take advantage more in terms of investing and longer term investments, then we are launching our investors section this week. So watch for that, where we will be kind of giving you, or we'll be doing all the work and giving you some ideas where you want to be putting your money over the next kind of month to years in terms of the span of those investments. So it's not in terms of days or weeks like we do in trading, but we go more expanded into weeks and months, which tends to be more accurate and gives you pretty good returns as well. So if you're interested in that, we'll be launching that this week. So keep an eye on your emails. You can sign up to get these game plans in your inbox every week. So you'll put that link below as well. And if you do sign up for that, we will send you any information regarding that investors section, our portfolio advisory service that we're going to be starting this week sometime. So cool, guys. Have a great one. Chat soon.